everybody, and thank you again for joining us today on Franchise Vibes, where we're going to discuss franchises and everything in between. And today, I have another treat for you guys, as I like to bring on many of the resources that I would have available to help you in this important journey so that you can make the most informed decision that you can. So the vibes we are today is financial freedom vibes. We're going to secure the bag through franchising. And we are here today with Michael Reeder from Reeder CPA Group. How are you?
I'm doing good, Tamika. Thank you for having me.
So, Michael, thanks again for joining us. Please tell us a little bit more about yourself and your company.
Absolutely, Tamika. So, my name is Michael Reeder. I'm a CPA, and I'm the owner of Reeder CPA Group. We're a national virtual CPA firm, and we have a niche working with franchise businesses. So I'm 38 years old. I've been in public practice as a CPA for about 14 and a half years. I owned the firm that hired me out of college. It wasn't like my dad's firm or anything. That's not a knock against second generation business owners out there. It's just a fact. And for the last 11 and a half years, I've developed a niche working with franchise businesses. And so what I've done for the last 11 and a half years is I've networked with franchise referral consultants, franchise brokers such as TAMIKA, as well as franchisors, FSOs, franchise development groups. I've created a nationwide network of franchise professionals to be a CPA resource for their franchise buying candidates. And so whenever anyone in my network of franchise professionals is working with a prospective franchisee, and that prospective franchisee is going through is going through the due diligence of investing in a brand, they're inevitably going to start to have questions about, hey, how should I structure my entity? How should I fund my business? Right. And so my nationwide network of franchise professionals refer their prospective buyers to me and my firm. And my firm, what I've built out over the last 11 and a half years is the Reeder CPA Group free CPA consultation call process to dive into entity structure funding, entity structure strategy and funding strategy, coming at those two things from the angle of strategic tax planning, as well as just overall accounting and tax strategy once you're in business. And so I started doing this in approximately 2014, 2015, with just a few franchise brokers. And here we are in August of 2025. And me and my firm were doing the exact same thing, just on a larger scale. And it proves to be a triple win, because it's a win for the candidate because they're getting great tax and accounting advice, entity structure funding advice during a crucial moment of their journey, which is about to buy a business and make a significant investment. It's a win for the referring franchise broker, franchise consultant, because they provide this valuable resource to their candidate, giving their candidate this additional clarity on these important subject matters. And it's a win for me and my firm because we get an opportunity to provide value to a prospective client of our firm. And so, a lot of the candidates that we work with after we, have one or two, sometimes three free CPA consultation calls with them, a lot of them naturally, once they're officially in business as a franchisee of whichever brand, then they come back and they work with our firm for ongoing accounting and tax services.
Awesome. Awesome. What a journey. Congratulations.
Thank you so much.
Yeah,
It's
it
been a
sounds
grind.
amazing. Yes, I see. I see. So many people think of franchising as just another job, but it can actually be a path to financial freedom. What are some of the key benefits of franchising compared to traditional business ownership?
It's a great question, Tamika. As a CPA, as a certified public accountant, whether you're an independent business owner, or you're a franchise business owner, if I'm looking at your financial statements, if you're a franchisee and I'm looking at your financial statements, the biggest difference that I see as an accountant on the financials of a franchisee is that I'll see an initial franchise fee on the balance sheet that the franchisee pays to the franchisor, and I'll see royalty expenses that the franchisee pays to the franchisor. Also required ad spend, et cetera, like the brand fund, et cetera. But the biggest difference that a franchise business has compared to an independent business is that you're in business for yourself, but not by yourself, right? So you have the backing of the brand, and so a lot of people that want to get out of the corporate grind and be their own boss, they are appealed to the franchise business model because the franchise business model has a proven brand and a proven system, a business in a box, so to speak, so that the franchisee, right, the aspiring business owner, right, and then new business owner can just go right into a proven system and follow the playbook provided to him or her by the franchisor, and just be off to the races. Whereas an independent business owner would have to figure everything out themselves from scratch. And so, by paying that franchise fee upfront, by paying that ongoing royalty, that's the cost of investing in a proven system. And then, even though that's a cost that you don't have when you're an independent business owner, it allows you to scale faster. It allows you to ramp up top line revenue and profit faster. And then one of the common things that I hear is, oh, well, why do I want to be a franchisee and pay that royalty? When you invest in a franchisor as a franchisee, yes, you pay the royalty, but then you're also privy to national vendor accounts that the franchise has. So you can get better pricing on cost of goods sold and various expense items that an independent business owner may have to pay, higher up. But because you are a part of a franchise brand, and that franchisor has negotiating power with a lot of their franchise with a lot of their vendors, so that mitigates the royalty. So these are all reasons why a franchise business owner can scale and ramp up quicker more than an independent business owner, because you don't have to make all the mistakes that you would have to if you were independent. Because as a franchisee, you're like, think of it like this: like, when you pay that initial franchise fee and those royalties, like, you're paying that so you don't have to make all those mistakes, because the franchisor already made those mistakes throughout the years and figured out how to improve them and to build the system, improve the system, et cetera, et cetera. So that's my long-winded response.
Before someone invests in a franchise, what are the top three financial must-have that they should have in place to ensure that they're setting themselves up for long-term success?
That's a great question. So, you know, um, it's a subjective question. So this is not the golden rule, but if someone is going to invest in a franchise, that each franchisor has their own required minimum thresholds. So, for example, like, if you want to invest in franchise XYZ, right? You have to have at least a minimum liquidity of whatever, 100,000, 200,000, et cetera, and a minimum net worth of fill in the blank, right? So do you meet the minimum liquidity and net worth requirements? And then also, do you have, like, is there income coming into the household that, whether it is you as the franchise buyer, you are also keeping your corporate job and you're going to burn the candle at both ends, or your spouse is bringing in income, or you have VA benefits or military pension if you're a military vet going into business, or you have some other sort of rental income, investment income, retirement income coming in from other sources. Is there income coming into the household that can support the household's living expenses while you ramp up your business? And then, of course, if there's not, that can be mitigated if you're sitting on a lot of cash or assets that you can leverage, for example. So liquidity, net worth, and is there some sort of household income coming in that can hold down the fort while you ramp up the business?
Nice, nice. So you know what? So now we want to secure the bag without losing it, right? So we know that financial mismanagement can be a franchise killer. What are some of the most common financial mistakes that you see new franchisees make, and how can they avoid them?
The biggest thing that I would say as an accountant, accountant or no accountant, this is just very important what I'm about to say, is that so many new business owners, so many new franchisees don't take their bookkeeping seriously from day one. And so, people, like, to many business owners, franchisees and independent, especially new business owners, bookkeeping is just this thing that you do when it comes time to file taxes. And we've all been there. We've all been there. Like, I'll speak for myself, right? Like, I own a CPA firm. I have 4 companies that roll into my personal return. I always found myself, um, for years, on my come up, like, doing my own books and my own taxes, like, at the last minute, like in September and October on extension, because I was so busy taking care of the rest of my clients. So I've learned to, like, even though I own a CPA firm, I have my own bookkeeper, and I have another CPA that does my taxes, believe it or not, because I don't have time to do them myself. And so, I had to, I didn't come to that realization until, later on in my career. But like, so I know from firsthand experience, I know how it is to be a business owner. Like, yes, I'm a CPA, I'm an accountant, I'm a tax professional, but I'm an entrepreneur and a business owner, just like all of you listening, and just like Tamika. And so, I know how it is as a small business owner to wear so many hats. And because you're wearing so many hats, you're so busy during the day, taking care of your clients, taking care of your team. You've got a family, you got to, take care of your family as well. You got to have this thing called a personal life. Sometimes I forget what that is, but, and then at the end of the day, to like, oh yeah, my books, I'll just get to that later. I'll get to it later. We procrastinate. It's human nature, et cetera, et cetera. And so the biggest piece of advice that I have for new business owners, new franchisees, is just view bookkeeping as a cost of doing business. And so, especially if you're a franchisee, like, unless, like, I am of the school of thought of, like, just get QuickBooks from day one, and just whatever it costs, QuickBooks Online, and, pay a vendor, whether it's an employee or a vendor or your CPA, just like have a third party do your book so you don't have to do it. If you're going to do it or your spouse is going to do it, fine, but stay on top of it. And just view it as a cost of doing business, right? Like, if you accept credit card payments, then merchant processing fees to the merchant processor is just a cost of doing business, right?
Yeah.
If you are a franchisee, then you're most likely going to have the franchise attorney review the FDD, the franchise agreement, right? Just a cost of doing business, right? Just view bookkeeping fees as just a cost of doing business. And because then if your books are updated from day one, then it streamlines the tax return preparation process. It also allows you to, with the snap of a finger at any time, be able to run current year financials and historical financials at any time, and to be able to see where your numbers are. And that helps with tax planning conversations. It helps with cash flow and profitability conversations. If you don't know where your numbers are, then you can't make financial decisions. You might be overspending in a certain, cost category that you're not aware of because you're not looking at your books, right? So make decisions based off of your financials, as opposed to just, what's in your bank account that day. And so that's a big part of, like, the shift of, non business owner mindset to business owner mindset, is just developing an internal control for your accounting system, right? Your bookkeeping system from day one. And whatever it costs, yeah, you don't want to be paying like $1 million, for a bookkeeper, but whatever it costs, just view it as a cost of doing business. And it's a write-off, right? It's a write-off. So for every dollar in professional fees, bookkeeping fees, you're saving 30 cents in taxes, high level, right? But just accept it as a cost of doing business. Don't try to cut corners on certain costs, including bookkeeping, and spend your mental energy on top line revenue, bringing in sales and making sure that the operations of the business are smooth. So that's the biggest thing, is just knowing your numbers, and you only know your numbers if you have a solid bookkeeping system in place.
Yeah, that's important. That's some very insightful tips there as well. And I do want to actually stay in the taxes space for a second. So, from an accounting and tax perspective, what should franchisee be doing to maximize deductions and keep more money in their pocket?
You know, Really, at the end of the day, the tax code is written for the self-employed. And so
Mhm.
even though you are a franchise, like, if you're listening to this, you're a franchisee, either an existing franchisee or a prospective franchisee, yes, you are, bound to a franchise agreement. And so there are certain things, that you have to agree to with the franchisor, as opposed to just doing whatever the heck you want on certain things. So there are certain things that you have to abide by, but in the franchise agreement as a franchisee, that may not be the case if you were just an independent business owner. However, at the end of the day, you're self-employed as a franchisee. You're self-employed in the eyes of the IRS. And
Mhm.
so that means, and again, like we touched on, at the beginning of the episode, the tax code is written for the self-employed. A lot of your expenses as a business owner, as a franchisee, are tax deductible, right? Royalties, tax deductible. Insurance, tax deductible. Occupancy, rent, tax deductible. The brand fund, the required ad spend, tax deductible, right? Whatever you pay your employees, tax deductible. dues and subscriptions, tax, software expenses. It's like all these things are tax deductible. You also can get tax write-offs for home office expenses. You also can get tax write-offs for business vehicle expenses, right? If you have a vehicle and if you need to get a new vehicle for the business, write off. If you had a vehicle and it was never used for the business, but now that you're self-employed, you're using it for the business, now you can get a tax write-off for it. Is there an opportunity to put family members on the payroll? I always like to talk about the legitimate family business, right? So,
Mhm.
if you have your spouse and or kids and they're involved in the business in some way, shape, or form, admin, marketing. I mean, let's be honest. Like I'm 38 years old, and there are a lot of like 15-year-olds out there that know social media better than I do. It's just a fact. And so, is there a justification to, put spouse and kids on payroll? And by giving your kids some earned income, that's a write-off for you. So, if you're at a higher tax bracket, you reduce your taxes. They pick it up as income on their return. They may be at a zero tax bracket or like a 10% tax bracket, but then you also create enough earned income for your children to, set up IRAs. Imagine putting
Mhm.
7 grand into your kid's Roth IRA from, the beginning all the way to age 18. You're setting them up for success. And then self-employed retirement plan, like you can get a solo self-employed retirement plans. You have a lot of discretion into like not only the employee contribution piece, but also the profit sharing employer contribution piece. 401ks, and then potentially even like defined benefit plans, cash back, just a lot of flexibility in terms of if you have enough free cash flow for your business, you wrote off everything, you still have a profit, you can make, you could do some really creative things with self-employed retirement plans. And so all of these chapters of the Internal Revenue Code open up when you're self-employed compared to just being, whether you're an employee in corporate, nonprofit, or government. If you're just a W-2 employee, you're restricted to what you can do. You drive to work every day. You can't write off, unless if your company's like reimbursing you for stuff, okay, that's good.
Mhm.
But if they're not, then, you're out of pocket on a bunch of stuff and you can't write it off as an employee. Whereas all that stuff you can write off when you're a business owner. And as a franchisee, right, again, you might be part of a franchise agreement, but you're still self-employed in the eyes of the IRS. You're a franchisee, but you can be structured as an LLC that's taxed as a sole prop, partnership, S corp, or you can be a C corp. You can be a Rob C corp or a regular C corp, and all of these different entity types are self-employed, business entity structures. And
Mhm.
and you run your franchise business through it. All these expenses you can write off that you're not able to when you're just a regular employee.
That transitions well into my next question because I wanted to talk about, particularly for the potential franchisees, as we just touched on, leveraging some funding options. So, funding is often a roadblock for aspiring franchise owners. What are some creative funding strategies that can help someone get started without overextending themselves?
This is exactly the bread and butter of what we talk about during the free CPA consultation calls with Reader CPA Group, which is this process that I've cultivated over the last 11 and a half years. And so the first thing is we always ask when it comes to entity structure and funding, right? First, we always get context on three buckets, right? Bucket one, what's the investment level, right?
Mhm.
Initial plus the first 12 months, right? Are you going to do, some home-based service business that's maybe like a 150,000 with like 50,000 is the franchise fee and then the other hundred's working capital for the first 12 months? Or is there some brick and mortar that's like, or is there like some sort of like one of those salon suite franchises that might be 1 million plus, or anything in between? One territory, multiple territories. So what's the investment level, initial plus the first 12 months? Then bucket number two, right? What's the allocation of assets on your personal financial statement, right? We're looking for cash, other liquidity, retirement, and real estate, right? And then bucket number three, what's your household income and expense looking like? Once we have those three buckets on a piece of paper, right? And we always have the AI taking notes as well, then we can start advising on optimal entity structure and funding, right? I might talk to one person and based off of their three buckets and they're all attached at the hip, I might say, you know what? I think that you should go LLC with an SBA loan, and here's why. And then
Mhm.
for the person B, to get all context, I get the context on their three buckets. I'm gonna say, you know what? You should go Rob C Corporation and just fund it with all Robs and have no debt, and here's
Mhm.
why, right? And so a couple things. One, so there's here are the different funding options, like in a nutshell, right? First, there's third party debt. So SBA. I'm a big SBA guy because the SBA, there's like over 7,000 franchisors that are on the SBA's approved franchise list. And so if you're a startup franchisee, then you can get startup SBA funding much easier compared to if you were a startup independent business. Right.
Mm-hmm.
So like if Tamika was just like, like starting like, like Tamika's senior home healthcare business, right? And it had no history, it would be much more difficult for Tamika or myself, right, to
Mm-hmm.
get that loan versus if we were to invest in a startup franchise that's in the senior home care space. And then with that being said, once you're in business and you try to do it without SBA to start, and then like month 9, month 12, month 15, you're like, you know what, now I want to go for SBA. At that point, even if you're a franchise, you're considered an existing business at that point. And so the SBA underwriter is going to want to see a couple years of historical cash flow, even though you're a franchisee. So, with all that being said, there's a use it or lose it dynamic to getting SBA funding while you're a startup franchise compared to startup independent. And then if you're a franchise startup and then you're in business, then you're existing. And then, so all these, so that's a big argument for the SBA. I'm a big SBA guy for that reason. There's also
Okay.
other third-party debt. I've got a 10 to 12 minute video that I made on ChatGPT. It's just me recording myself doing a ChatGPT search on how to search for municipal, county, state, federal, nonprofit loans and grants that are out there. So it's like if you're starting a business in, whatever, like if you're in, Charlotte, North Carolina, and whether you're in Charlotte proper or you're in some suburb of Charlotte, right? Like, and you're going into like a franchise business that's in the industry of, doggy daycare, right? Like there might be some random $5,000 like loan or grant at the municipal level just by being a new business owner in the municipality, or just by being a new business owner, um, in this certain industry, or there might be something if you're a certified women-owned business, or a certified minority-owned business, and or a certified disabled veteran-owned business, or any combination thereof at the county, at the municipal, county, state, federal, just all that stuff. And so third party, right? Like I'm a big fan of this is like for me personally, I'm a big fan of using other people's money instead of my own and preserving my nest egg, right? Other people in the context of banks, SBA, these various loan and grant programs that are all legitimate. If they're there for you, because as a small business owner, you're taking risk, and you're taking risk. You're going to build a business which is going to help the local economy, which is going to hire, you're going to employ people in the area, like most likely and stuff. So there are third party loans and grants out there, with the SBA being the biggest one, that are built for you as the aspiring entrepreneur. So all of that stuff. Again, there could be conventional bank loans. There can be unsecured. You have to be careful with unsecured because it's really expensive. So just read the fine print with unsecured. I see a lot of times people do unsecured like as a bridge loan. Like they might be waiting to sell their house, and their house is going to sell in 6 months. And when the house sells, they're going to have all this cash, but they want to do the business now because they don't want to lose out on that territory to someone else to buy that territory. So they'll get unsecured because that's the only option they have. High interest. It's like a bridge loan almost, right? And then once the house sells, get the cash, pay off the unsecured. Like that's one scenario where I see unsecured. And now leveraging personal assets, right? Of course, if you've got cash, you can use cash, right? But leveraging personal assets, right? Margin loans on non-retirement stock accounts, 401k participant loans, and home equity lines of credit. Those are the three biggest types of leveraging personal asset funding strategies that you can use, right? And then there's the topic of retirement asset funding. The biggest one that you see out there is ROBS C Corp, right? ROBS is an acronym for Rollover Business Startup. It's a way for you to, set up a C corporation and then set up a retirement plan for the C corporation, and then the retirement plan invest in the stock of the C corporation. So that's how you can use your money for your business now. So ROBS C Corp, but then there's also, like I said, 401k participant loans. There's also distributions of original contributions from Roth IRAs. And then there's also the feasibility analysis of just taking a regular distribution from your retirement and getting hit with the tax and maybe the 10% penalty, but being able to structure as a flow through entity so you can offset the taxable distribution with the startup business loss. And I always tell people, whenever the bank of family and friends is open for business, it's always something that's worth looking into, that doesn't apply to a lot of people, but it does apply to some people. And you'd be surprised how many people I talk to. They're like, yeah, like, my my parents are retired, and they really want to help me and my spouse, and like in their estate plan we're going to inherit everything or half of everything anyways, and so they really just want to help me on my okay, like if that's an option, it's worth considering, and there's no shame in it. But then sometimes that can be like a thing. It's like, yeah, that's there, but I want to do this on my own. I don't want to burden mom and dad and all that type of stuff. But all of these things, Tamika, are funding options. And when I talk to people, when my team and I talk to people, all the stuff that we just talked about, like they weren't even thinking about all these different ways that exist in order to get
Right.
the funding to start their business.
Nice, nice. I love how you broke that down and gave so many different options and things to think about as well. What I come across a lot also is people thinking about wealth building or just like that long-term wealth, that generational wealth. Um, how can franchise owners use entity structure and financial planning to create generational wealth?
The the name of the game is what Tamika just said, right? Like after tax generational wealth. Like that's the key. Tax savings is a part of that. As me and my team always tell our clients, we don't want the tax tail to wag the dog. And so even though the tax code is written for the self-employed, you can pay less money in taxes. At the end of the day, the key is to build a profitable business, right? And if you're a business owner, like, depending on how you're structured, all this type of stuff, your earning potential is greater as a business owner. Yet, more risk but more reward, right? And so your earning potential is greater as a business owner, and so you can, scale more top line revenue, have more profit. Yeah, there are some tax saving strategies that we can do to pay as little in tax as possible, but all of these things are part of the equation of what's known as after tax wealth. Building after tax wealth, accumulating it year after year after year after year after year, and then then that whole financial planning conversation and tax savings conversation, it delves into estate planning. Right now, what can you do to move your assets into trusts, right? Make your kids beneficiaries of the trusts, et cetera, so that you create and build a legacy for your family, right? And
Mhm.
so when you retire, when you pass away, your kids can take on and carry the legacy of the family business. And if not, at least know that they're protected, like they've got, income security from the cash flow of that business. And so all of that is much more possible when you are a business owner versus just an employee of a corporation or government or nonprofit, et cetera, et cetera. All of that stuff, in the latter example, is all being taxed at higher rates, which means that there's less for yourself, right? A lot of it's going into retirement plans, and so there's some like again, like your beneficiaries can inherit your retirement plans and stuff like that. Those are all things, but it's just overall there's more income producing and money making potential as a business owner versus not being a business owner. And then with that being said, as you create all that wealth, then it's going to inevitably go into an estate planning conversation where you can create a legacy for your children.
Mm. And you know what? I want to touch on exit strategies, because I think that that's something that's very important and we don't often speak about. So for the franchise owners that's looking to cash out or to scale, what are some smart financial moves to make sure that they maximize their investment when it's time to sell or expand?
It gets down to, preparing to exit from day one, right? Even if if you don't have any plans on exiting, because you're going to be in this for a long time, and or when you do exit, it's going to be a legacy play, for your beneficiaries. If you build your business as if you're exiting it, then all that's going to do is help you, even if you don't exit, right?
Mhm,
Because if you sell your business, that means it gets down to the classic, like, do you own a business or do you own a job, right? Most people out there own jobs. It's just a fact.
mhm,
It's much easier said than done to build, like, if you're self-employed, if you're a franchisee, even if you're not a franchisee, if you're just self-employed in whatever context,
mhm.
can you go on a 3-month vacation and just completely shut off And if no, it's perfectly fine because like, being self-employed and being able to work from wherever and, do whatever, like if you're working no matter what, like, you're still self-employed. That's still, there's still lots of perks to like, being self-employed and owning a job versus being a corporate employee. But when you sell, the buyer is going to want an asset worth purchasing, right?
Right.
And so things such as, is there, how much recurring revenue is there? How active are you as the seller? Are you an owner operator, or have you scaled, have you leveraged yourself out? So even though you own the business, you have managers and a team, and, you're not, working the business 60-hour weeks like other, owner operators out there. How strong is your management team? Do you have SOPs in place? Is your tech stack, what it should be in this day and age in the industry that you're in, right? Do you have concentration risk, right? Like, is 80% of your revenue coming from 20% of your clients? Like, that's a risk. All of these things are what, how secure is your data? How involved is the owner? That's what's known as key man risk, right? But these are all the things that are going to, make your business more valuable, that are going to increase the multiple of cash flow, that are going to increase the multiple of EBITDA, right? EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization, right? All of these things are like if you are a business owner, you're a franchisee, and you want to sell your business one day, put yourself in the shoes of the buyer. If you were the buyer, why would you
Right.
want to buy this? Most buyers don't want to walk in. People that are going to pay like a pretty penny for a business want to be able to pay for something that's already cash flowing and that they don't have to come in and do all the work. They want to pay for recurring revenue that's already there. They want to pay for a client list that's already there. They want to pay for uh, a lead generation funnel, pipeline, et cetera, that's already there. They want to pay for a team of key managers that's already there. And then, of course, when you want to exit, like, there are tax saving strategies that can be implemented. There's this thing called QSBS, qualified small business stock, that if you're a C corporation, a non-Rob C corporation, that you could qualify for potentially not paying any capital gains tax on the entire or the majority of the capital gain if you do the stock sale in what's known as a QSBS, qualified small business stock sale.
Mhm.
There's a variety, if you do the Rob structure, there's some things that you can do to save money in taxes by having the proceeds go into the retirement plan. There's various other things that you can do. Some sellers may just want to take the capital gain hit and then be able to have discretionary use of the money. As a general rule, the more fancy schmancy that you get with tax saving strategies at exit, if you want to say, if the priority is to save money in taxes, then you may have to put the proceeds of sale into some sort of vehicles that you're like the use is restricted for a certain amount of time. And then on the
Mhm.
flip side, if you want to just take all the cash, again, if it's not a Section 1202 QSBS, for example, if you want to just take the cash and be able to use it on whatever you want, then like, you know, more, than that, the cost of that is paying the tax. But all of these, at the end of the day, again, we don't want the tax tail to wag the dog, and the same thing is true for exit planning, right? The key is to sell the business for as much of a value as possible and then figure out how to save money in taxes, as opposed to getting so focused on tax savings when, and then because you're allocating all your energy on like paying this much in taxes, like the value of the company at exit is this much instead of this much, right? Like, chances are paying some tax on a valuation of this much is going to net out here, right? Versus paying little to no tax when the valuation is here. Like, the key is after tax wealth. After tax wealth. That's the name of the game. Tax savings is a part of that.
As we wrap up, I'm thinking about, the people, the persons that are looking at the title of this, financial freedom, securing the bag, things of that nature. And that's bringing them to click on to see, what this is about to learn. So keeping them in mind, what's the first financial move they should make today?
I really think that they should connect with a franchise consultant, like yourself, Tamika. And I'm not saying that, like everyone listening, Tamika did not tell me to say that, like, because franchise consultants like Tamika have access to an inventory of all of these different brands and all these different types of industries. And so, like what Tamika does is, more than anything, is she's providing education to bring awareness to all these different routes to business ownership that exist that so many people are not aware of. Most people, when they think of, being a business owner, they think that they have to start a business from scratch. And that's one option. But there's this whole, what I like to refer to as the business for sale marketplace. There's a whole business for sale marketplace that exists out there. And, Tamika, as a franchise consultant, she's got access to all these different brands that you, as the prospective franchisee, may not be aware of. And so bringing awareness to the business for sale marketplace, which is new franchise territories, franchise resales, independent non-franchise resales. Those are the, and like of those three things, the franchise new territory and the franchise resale are big components of the business for sale marketplace. And then that's another thing. When people hear the word franchise, they think of the NFL sport franchises and like Taco Bell and McDonald's, right? They think of
Mm-hmm.
like when the word franchise pops up, those are you talking about Taco Bell? Like the franchise business model exists in all these different types of industries. Yes, there are legacy brands, right? Like here, like Housemaster, is just an example. I'm just, this is just an
Mm-hmm.
example. I'm not, as a legacy brand that's been around for a while, but it's in home inspection. Like that's just, there are legacy brands out there. There's emerging brands, and there's all these brands in between and all these different types of industries. And so many people are just not aware that these are options.
And they've
And,
been around forever. They've been around for such a long time. They're very well established as well.
yeah, exactly. And they qualify for SBA financing if you were to go into one of them. So it's just like getting an education on all these things, start with a franchise consultant like Tamika. And then as you get, go through the process and stuff, then, you're going to need to get hooked up with a franchise attorney, right? And a franchise CPA, et cetera, et cetera. And then you're going to surround yourself with your team of advisors. But just start out by working with a trusted professional that knows a lot about the business for sale marketplace, which includes franchises, right? Such as Tamika, and just get an education on all this stuff, right? And then so you as the prospective, franchisee out there, you get all of this knowledge that you didn't have before about, whoa, it's like if I actually want to be my own boss, there's all these different options available to me, and it's easier than I thought. Now it's not, you still got to work, you got to put the work, and
Oh
you
yeah.
can't just, like there's a bit like, like you still have to put in the work. And but there are all these options that exist that you may not be, like if you want to be a business owner, there's a whole world out there in the business for sale marketplace, franchise, new and resale, that exists. Funding options, there's a whole bunch of them, like we just talked about. Start by talking to a franchise consultant like Tamika, and then she'll surround you with the proper team of advisors as you go through the process.
You know what? Thank you so much for that, Michael. And as he said, and I always joke around, I'm like, I didn't tell him to say that. It's just I love when it naturally does come out that way. And this is the reason why I do what I do as well, and why I have people like you on, is because I do want to provide that level of education, and the fact that I do have access to many different resources as well that can help you in this decision process. So thank you again for that. Thank you for joining us today on Franchise Vibes. And until the next time, everyone, take care. Bye bye.